bulk of the population still is rational. So until and unless I know markets try to preempt these things happening from happening, and some
Well,
of
I
these
think when
conclusions
things
are
hit
from.
this, I think when things burst through the roof, no one will be rational. I don't think so. Yeah. So I think let's move to the
Okay.
next topic. Yeah. So
It'll
Robin.
take time. That's what I
Okay.
feel.
Okay. So let's move to the next topic, that is
Robinhood versus hedge
Robinhood
funds.
versus hedge fund managers. So I'll just give you some important stats
Okay.
regarding that. Uh,
Sure, sure. Yeah.
yeah. So
Yes, yes. Go ahead.
according to a study, last year Robinhood had outperformed the hedge fund managers. By margin of how many points?
Not precisely sure.
Yeah, 16 percentage points, right? And I'll tell
Okay,
you, and
okay.
I'll tell you why this thing matters a lot, because the average pay of a hedge fund manager. Can you guess the amount?
I know their fee structure. The most common fee structure is 2 by 20, like 2% of capital and
Yeah.
20% of profits.
So in absolute amount,
Yeah.
how much do you think you would be earning?
50 million plus.
So the average amount is 650 million. The average hedge fund manager.
Average of all hedge fund managers
Yes,
or
yes,
just the
yeah.
top 10 or
No,
20?
no, average of okay, that I don't know. I think the average, from what I heard, the average hedge fund manager
Yeah,
has got a
because
payout of.
if you consider the Barclays index, hedge fund index, I don't think so. The aggregate will be that high.
Okay, so maybe if you look
Yeah.
at the top 10 hedge fund managers, they get an average of 650 million, right? So basically, these are
Okay.
hedge fund is for the rich
Hedge
people.
funds.
And these guys are underperforming Robinhood investors, who are basically millennials who have no clue of, like George Gammon calls them TikTok investors, right? And I
Yeah,
saw one,
exactly.
TikTok video where one was saying that how he doesn't go to 9 to 5 jobs. So his investing strategy is very simple. He carefully looks at the stock price, and when it's going up, he keeps buying
He
and
buys
buying.
it.
And then when the stocks start going down, he starts selling it, and that sells his 9 to 5.
Exactly.
And if you actually see
Yeah.
the what the study says is their strategy is very simple. They look at high volume stocks. That's it. And Robinhood investors, they don't look at the fundamentals. They just buy a high volume stock. And to see whether
Hmm.
it was just a matter of last year, they backdated
Hmm.
this strategy up till 1983, right? And they
Yeah.
found out that this Robinhood strategy of just buying all these high volume stocks, which had the highest turnover, had beaten the index every single year, right? I don't think S&P index every single year. So, Halang, this is a very funny situation
They did it
where
unknowingly and irrationally, and
yeah, again,
the hedge
say
funds.
say if people are beating you for 2 decades, then we can't
Hmm.
maybe call them irrational. Maybe they know something that we don't. I mean, from a finance point of view, what we learn
No,
at
no,
MBA.
we're calling them purely one second. Yeah, we are calling them purely once irrational or
Yeah.
rational because, frankly, when they speak, they're ridiculous. They don't even know what they're doing. That's why
Yeah,
we're
yeah.
calling them rational or irrational. Yeah,
Yeah, so from a finance point of view, like what we have learned in MBAs and all, it doesn't even match what theory we have learned,
match.
and the trading strategies they use. I mean, from what I know, people to just get 1% alpha, the amount of reading strategies they have to do, and suddenly these
Yeah.
Robinhood guys and why is this happening? Any idea? And what is this new
See, the
Robinhood
year
phenomenon in the?
2020,
Yeah,
I mean, historians will always come back to the year 2020 and look at what happened, and it's gonna be amazing, man. Let me give you an example first, okay?
okay.
Renaissance, right? Jim Simon's Renaissance
Yes,
Technologies.
yes, yeah,
So these guys have basically two classes of funds. One is Medallion, which
yeah,
manages money for their own employees and the promoters themselves, that is Jim Simons and others.
yeah.
So Medallion this year went up by 78%, and
Okay,
the other class of funds are for institutional investors. So one specific fund is called the Renaissance Institutional Equities Fund and
yeah,
Renaissance Institutional Futures Fund. Now these massively tanked against the market. So the
okay,
money that they managed, did well, and while the money they managed for the other investors or
yeah,
institutional clients didn't do very well. And
okay.
and the ridiculous reasoning that they gave for this is, I'm quoting them exactly. Okay, so this is what they said:
Your voice has broken down.
that the world is wrong.
Your
Keep
your
in again.
your voice has broken down completely. Like didn't hear it. Just
Yeah,
repeat
yeah.
it.
So I'll just quote what they said. One
Yeah,
second. Am I clear now?
yeah, yeah, yeah.
Yeah. So I'm just quoting what they said. So what this spokesperson said is, the fund has a 6 month to 1 year holding period, and
Yeah.
it uses factor-based models to hedge risk. There is nothing wrong with the models. It's just that the world is wrong. Okay, I'm
Okay.
emphasizing on it's just that the world is wrong. And the next uh, uh, line says, the unpredictable patterns of risk behavior created by the disruption of COVID-19 and the idiosyncratic distribution of stimulus money created unprecedented pattern of stock price movement that couldn't be possibly adapted by quantitative strategies. So put another way, quant models, are built for on the basis of historical patterns, right? So when there has not been a pandemic in at least 100 years.
Okay.
So these models cannot get those patterns, or cannot adapt to those price moves.
Okay.
And the funds themselves is acknowledging the fact that the stimulus money that came into the market, the Fed's
Yeah.
monetary easing, they influenced stock prices in a way that happened never like before. So my question is, why were they still following that systematic trading strategy? This is a year where discretionary trading, or meaning discretionary trading is a kind of trading where you trade. Every single trade is different. You have a different reason, rationale, and logic for every single trade. While systematic trading is, you have a system, you have a time defined pattern that exhibits itself in the market, and whenever you find an opportunity, your system trades and invests it automatically. So in a year where discretionary trading was ahead of systematic trading, and when they clearly knew about it, why did they stick to these systematic trading strategies? That is a big question for all hedge fund investors. Why did these funds stick? Because they knew that their strategies were going to do badly in a year like this. I mean, it was evident when the Fed came up with unlimited QE. It was clear that the markets would not react like they did
Okay.
during the Great Depression or the global financial crisis, for instance, because this was an unprecedented policy move on the side of the Fed, and later even the Treasury came up with a lot of different activities, and they propped up the markets back up. And even mid-year, they could have left these kind of strategies, but why didn't they do it? And the second thing is, this is a year that has also taken the 2020 basically was also a year where the conviction of a lot of hedge fund managers got destroyed. They were hellbound. Everybody as I said, on March 23rd, thought of it as the end of the world. They
Okay.
didn't book their profits. A lot of these funds were in profits when the S&P hit 2,180, and they
Okay.
didn't book their profits. They were expecting even lower levels like 1,800, 1,600. I had read several Twitter and LinkedIn posts of some famous fund managers who said that this is where it's destined to. But they stuck to their convention. They worked rationally and logically, and this was the end result. As John Maynard Keynes says, the market can be irrational longer than you or I can.
Okay.
That exactly played out in the next half of the year, and
Okay.
the other guys came on top of that. So hedge fund managers stuck to their. I see two things as problems. They stuck to their systematic investing strategies when they knew that it was the year of discretionary trading. That's the first mistake they did.
Okay.
And the second mistake is they stuck to their convictions. They acted rationally when they were supposed to act rationally, because in times like these is when everybody's going to act rationally, okay, and you're gonna get nothing out of that, okay.
Okay.
If everybody thinks that the market is going to go 6,000, 5,000, frankly, it's not going to go to 6,000 and 5,000 because so many people are expecting it to, and it never happens like that.
So it
That's
will
a
be
law of
priced
market.
in. That will be priced in automatically, right? The thoughts will be priced
Automatic.
in automatically. Yeah.
And it's not like 7 or 8 years of economic growth can go into nothing just because of COVID. Okay,
Yeah. Yeah.
I mean you could be set back by a few 1 or 2 quarters. It's not like 7 or 8 years of economic growth is going to be wiped out because of COVID. Its
Yeah.
initial reaction is always an overreaction in
Okay.
markets, in
Okay.
financial markets. You need to understand that they have a lot of investing experience and stuff. Guys like Ray Dalio, man, guys like Ray Dalio, actually, they went on TV and said it's the end of the financial world. All these things, I'm not putting them point to point, but yeah, the gist of that. Because at the beginning of the year, Ray Dalio was a big guy on TV. He had got a
So
lot
how
of
were the Robinhood investors different? I mean, one way is different was they had no clue what they are doing, right? But
because Robinhood investors are not so educated and enlightened. They do
yeah,
not have the burden of knowledge in their heads. See, I know a lot of stuff about options, but if I'm going to buy plain options, I'm going to think about Greeks. I'm going to think about different theories like Max Payne, stuff like that. You can make things really complex, but
yeah,
it's not going to help me. Okay,
yeah,
I might have several different positions about the market, but if I cannot differentiate between what works and what doesn't work, it's of no use to me. Okay,
yeah,
I think the benefit, the edge that Robinhood investors had in 2020 was the lack of their understanding of complex financial markets. All they
okay,
knew was buy rationally, and everybody there was trying their luck. Okay, that's
yeah,
basically what's happening. Very few people went in with their savings, but the bulk of the people were just going trying their luck. It's like sports betting or casinos, like they have it in the United States. They were trying their luck, and they got incredibly lucky because it was 2020. But that's not going to
okay,
work every year.
yeah.
Yeah, I mean, yeah,
Jim, this Kramer from CNBC says that this Robinhood is like metaphorically
hmm.
true. Like they have taken money from the rich and it has been distributed to the poor. So in a way, you can say in like last year, like the hedge funds have been beaten and wealth has been taken from them and has been like
No,
distributed.
hedge funds is gone. Whatever money that has come into the system went to Robinhood traders. I think you can see it
Yeah.
like that. You
Okay.
don't necessarily
Okay.
see it as wealth being taken from the rich, but whatever money was injected by
Yeah.
the Fed and other
Yeah.
centers, that went into the accounts of Robinhood and traders
Okay.
worldwide. And
And
if we see,
I think a big reason is even the retail investor finally understood the Federal Reserve put, right? Because they understood that the Federal,
the shocking thing is, Robinhood traders and Wall Street bets understood the importance of the Fed and didn't undermine it, but hedge fund
yeah,
traders did.
okay,
Yeah,
okay,
they really undermined the effect of the Fed, the
yeah,
overall impact of the Fed at the end of everything.
yeah.
They really
So
strategies.
yeah, so you are saying
Yeah.
the Robinhood investors understood very well that the Federal Reserve will be there to backstop the stock market. Uh,
Maybe they thought that the Fed was some kind of a person with endless means and could set everything back because that's how the Fed promised initially.
okay,
But
okay,
hedge fund managers, I think they ignored it, man.
yeah,
They definitely underestimated, or they would have not stuck with those
yeah.
strategies and all. Yeah.
And then you have this cult-like following of certain companies like a Tesla or a Netflix, who have
I got you.
benefited a lot because of social media. That is also another big factor in investing. Social media is finally a factor in the social media and even
You
memes, even
the point.
memes.
Yeah,
Even memes are a big factor in the investing space,
exactly.
especially in momentum investing. And I think that is where
Knowledge actually.
no, I did, actually your voice broke. Will you just say it again?
These memes have actually become a source for the transmission of financial knowledge because I've seen some wonderful memes
Yeah,
which
yeah,
convey very simple.
yeah, yeah,
Yeah,
yeah.
it's educated investors, in a fun and nice way.
Yeah, so I think that
To
is
say.
where most of these hedge fund managers, I think they're 50 plus, and that is where I think the millennials
Hmm.
had an edge over these guys.
And
So let's see what
they built
unfolds.
cult
Yeah,
and top the market. Yeah,
yeah. So let's see what happens for the next next year,
yeah,
say 5 years. So another topic that
2020.
comes, yeah. So
Yeah, next
another
5 years will be event.
yeah. So another topic that we have is passive